Money. It shapes our world, fuels our desires, and defines our aspirations. From the humble coins in our pockets to the complex algorithms driving global finance, money's influence is undeniable. But have you ever stopped to consider where it all began? How did this seemingly simple concept evolve to hold such immense power over our lives? This essay embarks on a journey through the history of money and finance, exploring its remarkable evolution from ancient barter systems to the sophisticated financial instruments of today. We will delve into the key milestones that have shaped our economic landscape, from the rise of banking in Renaissance Italy to the devastating impact of the 2008 financial crisis. Understanding the history of money is not just an academic exercise. It offers crucial insights into the forces that drive our economies, the interconnectedness of global markets, and the potential pitfalls that lie ahead. By examining the past, we can better navigate the complexities of the present and shape a more stable and prosperous future. Join me as we unravel the captivating story of money, a story that is intricately woven into the fabric of human civilization itself. In the beginning, there was barter. Before the advent of money, our ancestors relied on a simple system of exchange, trading goods and services directly. A farmer might exchange a bushel of wheat for a blacksmith's tools, a transaction based on mutual need and the perceived value of each item. However, bartering had its limitations. Imagine trying to find someone who not only had what you needed, but also desired what you had to offer. This double coincidence of wants proved cumbersome and inefficient, hindering economic progress. The solution emerged gradually. Money, early forms of money such as cattle or shells, were chosen for their inherent value and relative scarcity. Yet, it was the invention of coinage, attributed to the Lydians in the 7th century BC, that revolutionized commerce. Coins, typically made of precious metals like gold and silver, offered a standardized, durable, and divisible form of money. Their introduction simplified transactions, facilitated trade over long distances, and laid the foundation for more complex economic systems to flourish. Fast forward to Renaissance Italy, a period of immense artistic, cultural, and economic transformation. It was here, amidst the bustling city-states, that modern banking emerged, forever changing the financial landscape. At the forefront of this revolution stood the Medici family, shrewd merchants and bankers who rose to prominence in 15th century Florence. The Medici grasped the potential of finance to generate wealth and exert political influence. They established a network of banks across Europe, financing everything from grand cathedrals to ambitious military campaigns. One of their key innovations was fractional reserve banking, a system where banks lend out a portion of their deposits, creating new money in the process. While this practice fueled economic growth, it also introduced new risks, as evidenced by occasional bank runs and financial panics. The Medici legacy extends far beyond their vast fortune. They demonstrated the power of finance to shape economies and societies, leaving an indelible mark on the development of modern banking. Their story serves as a reminder of both the immense benefits and potential dangers of financial innovation. As nations grew and engaged in costly wars, new methods of financing were needed. Enter the bond, a financial instrument that allowed governments to raise capital by issuing debt to investors. One of the earliest examples comes from the Italian city-state of Venice in the 12th century. Facing a war with Constantinople, Venice issued bonds to its citizens, promising to repay the principal plus interest at a later date. This innovative approach allowed Venice to finance its military campaigns and solidify its position as a maritime power. Bonds quickly spread throughout Europe, becoming an indispensable tool for governments to fund wars, infrastructure projects, and other expenditures. The bond market also provided investors with an avenue for earning a return on their capital, further fueling economic activity. Section 5. The rise of stock markets. From coffee houses to Wall Street, imagine a world where companies could only grow as fast as their founders' personal wealth allowed. The development of stock markets shattered this limitation, enabling businesses to raise capital from a wider pool of investors. The origins of stock markets can be traced back to 17th century Amsterdam, where shares of the Dutch East India Company, one of the world's first multinational corporations, were traded. These early stock exchanges were often informal affairs, conducted in coffee houses and taverns. However, the concept quickly gained traction, spreading to London and then across the Atlantic to New York City, where Wall Street would eventually emerge as the epicenter of global finance. Stock markets provided companies with access to much-needed capital for expansion, while offering investors the potential for significant returns. The rise of stock markets fueled industrial revolutions, technological advancements, and unprecedented economic growth. However, it also introduced new forms of volatility and risk, as evidenced by speculative bubbles and market crashes throughout history. Section 6. Taming risk, the origins of insurance. From natural disasters to unforeseen accidents, life has always been fraught with uncertainty. Insurance emerged as a way to mitigate these risks, providing individuals and businesses with financial protection against the unexpected. The roots of insurance can be traced back to ancient maritime societies, where merchants shared the risk of shipwreck by pooling their resources. However, it was in 17th century London that modern insurance took shape. Lloyd's of London, established in a coffee house frequented by ship owners and merchants, became a hub for insuring ships and their cargo. This innovative approach to risk management allowed businesses to operate with greater confidence, knowing they were protected against potential losses. Over time, insurance expanded to cover a wide range of risks, from fire and theft to illness and death. Today, insurance plays a vital role in stabilizing economies, providing individuals and businesses with peace of mind and financial security. Section 7. Bricks and mortar. Real estate's impact on economies. Real estate, encompassing land and any permanent structures built upon it, has long been a cornerstone of wealth and economic activity. From ancient civilizations to modern megacities, the value and use of land have shaped societies and fueled empires. The agricultural revolution saw land emerge as the primary source of wealth, with control over fertile land translating into power and prosperity. As cities grew, real estate played a pivotal role in shaping urban landscapes, influencing trade, housing, and social structures. Throughout history, real estate bubbles and crashes have had a profound impact on economies. The Great Depression of the 1930s, for instance, was partly triggered by a collapse in real estate prices. Similarly, the 2008 financial crisis was fueled by a subprime mortgage crisis, highlighting the interconnectedness of real estate markets and the broader financial system. Section 8. The Global Financial Crisis, a crisis of confidence. The year 2008 witnessed the most severe financial crisis since the Great Depression, sending shockwaves throughout the global economy. What began as a subprime mortgage crisis in the United States quickly morphed into a global credit crunch, exposing the interconnectedness and fragility of the modern financial system. Years of lax lending standards, coupled with complex financial instruments like mortgage-backed securities, created a perfect storm. As housing prices plummeted, millions of homeowners defaulted on their mortgages, triggering a domino effect that brought down banks, investment firms, and entire economies. The crisis exposed critical flaws in financial regulation, risk management practices, and the very structure of the global financial system. Governments around the world were forced to intervene on an unprecedented scale, injecting trillions of dollars into the financial system to prevent a complete meltdown. The 2008 financial crisis serves as a stark reminder of the interconnectedness of our global economy and the importance of sound financial regulation. It highlighted the need for greater transparency, accountability, and a renewed focus on long-term stability over short-term profits. Section 9. Conclusion: Navigating the Future of Finance. From ancient barter systems to the complexities of modern finance, the journey of money has been one of constant evolution and adaptation. As we navigate the 21st century, understanding this history is more critical than ever. The rise of cryptocurrencies, the growing influence of fintech companies, and the ongoing debate over monetary policy underscore the dynamic nature of finance. The lessons learned from past crises, the innovations that have driven progress, and the enduring principles of sound financial management will continue to shape our economic future. By embracing a balanced approach, one that encourages innovation while mitigating risk, promotes transparency and accountability, and prioritizes long-term stability, we can harness the power of finance to create a more prosperous and equitable world. The future of finance is in our hands, and by learning from the past, we can shape a more secure and sustainable financial future for all.